Let me ask you a simple question that most people never ask out loud. What if a huge part of the financial system is not made of money at all, but made of promises about money? Promises stacked on top of promises, traded back and forth, priced like they're solid, even though almost nobody ever asks for real settlement. And what if silver, yes, silver, ends up being one of the first places where that hidden layer starts showing cracks? Not because silver is magical, but because silver is small enough that real-world supply can't fake it for long? If you like clear story-style explanations that connect markets to real life without the confusing Wall Street language, please hit like and subscribe in the next second. It helps this video reach more people in the US who are trying to understand what's happening before it turns into a headline. And it also tells me to keep making these deeper breakdowns, because this topic matters more than most people realize. Now, I'm going to be careful with words like Ponzi, because that term has a specific legal meaning, and I'm not here to accuse anyone of a crime. But I'm going to explain something that can feel Ponzi-like to everyday people. A system where confidence is maintained because most participants never demand the underlying thing, and the moment too many people ask for the real thing at once, the system has to change the rules, widen the spreads, delay delivery, or settle in cash. That dynamic exists in more places than people want to admit. And silver can act like a spotlight because the physical market is tight, global demand is real, and the paper layer on top is huge. Let's start with the core idea. A derivative is basically a contract whose value is derived from something else. In normal use, derivatives can be useful. A manufacturer hedges input costs. A miner hedges revenue. A refiner manages price risk. That's the practical side. The problem is, what happens when derivatives stop being mostly about hedging and start becoming a massive universe of trading, leverage, and synthetic exposure that grows far larger than the underlying physical market it references? Think of it like this. If one home exists on a street, but 100 different people are trading claims on that home, options to buy it, futures on its value, fractional interests, insurance policies, resold agreements, you can create a lot of financial activity without changing the physical reality that there is still only one home. It can look liquid, deep, and stable, until a moment arrives where multiple people try to convert their paper claims into something real at the same time. Then the system has a choice. Either find a way to deliver the real thing or change the settlement terms. Silver is one of the easiest places for regular people to understand this, because silver has a very clear physical side. Real bars, real coins, real manufacturing demand, real shipping timelines, real minting capacity, real inventory. And silver also has a huge paper side. Futures contracts, options, unallocated accounts, synthetic products, and funds that track price. Again, this isn't automatically evil, but it creates the possibility of a disconnect. Paper can expand quickly, while physical cannot. So, what does it mean when I say the derivatives layer is too big? It means the system can create far more financial exposure to silver than there is immediate, deliverable silver available at a stable price. It means the market can quote a smooth spot price on screens, while in the real world, the cost to actually get silver in your hands rises through premiums, delays, and availability issues. And that is the key phrase. Premiums are the physical world's way of arguing with the paper world. If you've ever tried to buy physical silver in the US during a hot market, you already know this feeling. You see the silver price online, then you check coins or bars, and the real price is higher, sometimes much higher. You might even see back orders, limited quantities, or dealers widening the buy-sell spread. That spread is not just a dealer being greedy. A lot of times, it's the dealer protecting themselves because they don't quick trust they can replace inventory at the screen price. In other words, physical reality is forcing caution. Now, here's the storyline that makes this whole topic click. Most of the time, the paper market sets the reference price and physical follows. But under stress, physical can lead and paper can lag. When physical leads, you get a weird moment where the official price looks calm while the real clearing price is happening elsewhere, through premiums, through regional price gaps, and through who is actually able to source bars. That brings us to something you've probably heard about, silver trading higher in Shanghai than in Western hubs. People call it the Shanghai premium. You don't need to be an expert on Chinese markets to understand why it matters. It matters because it can be a sign that real metal is being bid up where demand is immediate, and it can persist because moving metal across the world is not frictionless. Shipping, insurance, bar standards, refinery capacity, import rules, taxes, financing costs, timing risk, those are real constraints. So when Shanghai stays higher, it's like a signal flare saying, physical demand here is strong enough to pay up. If that lasts, it can slowly pull supply toward the highest effective price. And this is where silver starts showing the derivatives layer, because a massive derivatives market relies on the assumption that settlement can remain smooth and confidence stays intact. If physical tightness persists while paper pricing stays too comfortable, the question becomes unavoidable. Is the reference price actually clearing real supply, or is it clearing paper supply? Here's a calm, honest way to say it. In paper markets, most participants don't want delivery. They want exposure. They want profit and loss, not pallets of metal. That's normal. But the entire system still depends on the belief that delivery is possible on reasonable terms if needed. That belief is the anchor. When physical signals start contradicting the paper quote for long enough, that anchor starts to wobble. And when anchors wobble, markets don't debate, they reprice. Now, let's talk about why silver specifically is such a sensitive stress test. Silver is not as large and deep as some other markets. It is heavily used industrially, so demand can be steady even when investors are uncertain. And it's also used as a monetary metal, which means investor demand can surge during fear cycles. When you combine steady industrial pull with bursts of investor buying, physical supply doesn't have the flexibility to instantly expand. Mining takes time. Refining takes time. Minting takes time. Shipping takes time. Paper contracts don't take time. That difference in speed is the whole story. This is also why system break moments can feel sudden even when they build slowly. For weeks, you might see small clues. Premiums stay stubborn, spreads widen, delivery times stretch, Shanghai stays elevated, inventories trend down, and the market keeps brushing it off. Then, one catalyst hits. An inflation surprise, a Fed tone shift, a sharp move in the dollar, a geopolitical shock, a liquidity event, and suddenly everyone looks at the same constraints at the same time. That's when paper positioning can unwind quickly and silver's moves can become violent. Let me explain that violent part in plain English. Silver often trades with leverage in futures and options. When price moves through key levels, some traders are forced to buy back shorts to control losses. Options hedging can also create reflexive buying. If the market crosses major strike prices, hedging flows can accelerate the move. You don't have to trade options to feel the effect. You just have to understand that once the system is already tense, certain levels can act like ignition points. And the deeper point is this. If the derivatives layer is extremely large relative to the underlying physical market, small shocks can create outsized reactions. Not because the physical world changed overnight, but because the paper world is crowded, leveraged, and sensitive to confidence. Now, I want to connect this to something very practical for a U.S. audience. In America, most people's wealth is tied to paper assets. Bank accounts, bonds, retirement accounts, index funds, pension promises. Those are not bad, they're just claims. They work because confidence works, because settlement works, because liquidity works. But when liquidity gets stressed, paper systems protect themselves. They widen bid-ask spreads. They reduce risk. They increase margin. They change terms. That's not a theory. That's how risk management works in the real world. In metals, that protection can show up as higher margin requirements in futures, wider spreads in physical, and more preference for cash settlement behavior over delivery. Again, I'm not saying the market will collapse tomorrow. I'm saying the mechanism exists. And when physical tightness grows, the probability of these protections increases. So how do you recognize that the derivatives layer is too big without staring at complicated charts all day? You watch the relationships. You watch whether physical behaves independently from paper. Here are the clearest behaviors that signal stress, and I want you to listen for the pattern, not memorize the list. If spot price dips, but physical premiums don't come down, that's a sign physical demand is firm or physical supply is tight. If spot price is flat, but physical becomes harder to source, that's a sign the reference price may not be clearing real availability. If regional premiums, like Shanghai, persist, that's a sign the global pipeline isn't instantly closing the gap. If dealers widen spreads dramatically, it often means replacement risk is rising. If delivery times stretch, it often means the pipeline is congested. And then there's the futures structure itself. In stressed commodity markets, the pricing between near-term and later-term contracts can start behaving differently because now becomes more valuable than later. That's the market whispering urgency. It's saying, we want real availability, not just exposure. When urgency rises, while physical premiums stay high, the paper layer is being challenged from two sides. Another clue is borrowing conditions, sometimes discussed as lease rates. You don't need to be technical here. Just remember, abundant things are cheap to borrow. Scarce things are expensive to borrow. If the cost of accessing metal rises behind the scenes, it often echoes forward into premiums and spreads. Inventories are another piece people talk about a lot, sometimes too dramatically. Inventory numbers can be misunderstood and they move for many reasons, but trend matters. If deliverable inventory trends down over time while demand stays strong, the cushion gets thinner. A thin cushion in a highly financialized market is exactly how small events become big events. Now let's bring this back to the title because I want you to feel the why emotionally, not just intellectually. The derivatives layer being too big isn't scary because it's complicated. It's scary because it changes what price means. In a healthy market, price is the number where real buyers and real sellers clear. In an overly financialized market, price can become a number where paper buyers and paper sellers clear, while physical clears somewhere else through premiums and availability. That is a subtle change, but it's a huge change. And that's why silver is where it starts to show. Because you can't eat a futures contract. You can't solder a circuit board with an option. You can't build solar capacity with a promise. Eventually, industry needs material. Eventually, retail wants delivery. Eventually, someone asks for the real thing. And when enough people do that in a market that has layered too many claims on top, the system has to respond. Now, does that mean everyone holding paper exposure is doomed? No. Many paper products are designed for exposure, not delivery, and they can function fine for that purpose. The point is about signals and confidence. The point is that physical tightness can reveal how dependent price discovery has become on paper behavior. And if that dependency is extreme, repricing can happen fast when confidence shifts. Here's the quiet exposure moment that I think is the most important. It is when you realize that the market can stay calm on the surface while the cost of certainty rises underneath. Physical silver is certainty. It's not someone else's promise. It's not a settlement policy. It's not a counterparty risk. And when the cost of certainty rises while the screen price stays too polite, that's a message. So what do you do with this message? Not panic, not rush, not make emotional bets. The smart move is to stay observant and grounded. Watch how premiums behave. Watch whether regional gaps are closing quickly or staying stubborn. Watch whether spreads are tightening or widening. Watch whether the system is clearing smoothly through price or slowly through rationing. And now I want to give you one simple test you can use this week that cuts through almost all the noise. The test is not a chart. It's not an opinion. It's behavior. When silver pulls back on the screen, does physical become easier and cheaper to buy within a few days? If yes, the system is relieving pressure. If no, if physical stays tight, premiums stay high, and dealers still act cautious, then physical is telling you the underlying market is tighter than the paper quote suggests. That is silver showing you the derivatives layer is stretched. Before we wrap up, I want to hear from you because this is where the best data often comes from. In the comments, tell me what you're seeing in the US right now. Are local dealer premiums coming down, staying stubborn, or moving higher? Are certain products always in stock? Or are you seeing more back orders and delays? And if you thought I've noticed a big difference between the spot price and what you can actually buy, describe it in one sentence so everyone can compare notes. If this video helped you understand why silver keeps showing stress signals before the mainstream narrative changes, please share it with one friend who still thinks price is price and doesn't understand premiums, spreads, and physical availability. Stay calm, stay curious. The first warning doesn't always look like a crash. Sometimes it looks like a simple, stubborn truth. The real thing costs more than the paper says it should.